All right, Ridham Desai of Morgan Stanley also joins us now. Ridham, if by now markets have digested the fine print of the budget, a lot of nuances, it's been brushed, it's been combed. So from a market standpoint, even though there is no wow factor, is it more like a relief rally? I mean, thank God the event is over.
Yeah, Nikunj, actually there is not much fine print, so there's not much to digest. And I think that's one key takeaway, because over the years we've just become so used to and paranoid about fine print, and successive finance ministers have planted bombs into their fine print. So thankfully this budget did not have any fine print. I think the wow factor in this budget is the government's commitment to reduce debt to GDP from 68 to 60%. I think we're not doing enough justice to this headline commitment. I think it sets the stage for some significant fiscal consolidation over the next 4 or 5 years, something which future governments may not be able to renege on so easily. Because the fiscal math is sometimes subject to manipulation. It's very hard to actually fudge debt to GDP number. And if you notice, rating agencies have more recently been saying this as well. And Morgan Stanley also actually said this in their recommendations to the finance ministry, that you should actually target debt to GDP. And I think that's what they have done. So to me, that's one major thing in the budget. The second thing is about the SME sector. You see, even though they do not account for large amount of profits, they account for large amount of employment. And it was a difficult choice, I think, for the finance minister whether to cut overall corporate tax rate by 1% or to boost a certain section of the economy by doing a major tax cut like he did for the SME sector. I think for me, combined with mass housing, that raises the specter for accelerated employment growth in the coming months. So that supports what is anyway an economy that is actually recovering quite nicely. It took a little bit of a beating from the cash exchange program. It was already on its way to recovery middle of last year, and I think that recovery will probably sustain with this type of budget. So those are the couple of things that I would highlight as major things in this budget.
Mm-hmm. Ridham, hi, good morning. And an extremely critical, I guess, is going to be next week's RBI policy, and then, of course, the big state elections, Uttar Pradesh being the key one. Do you sense in the near term, though, that could make markets a little nervous, because a lot of hopes are riding high on whether or not the government is going to be able to deliver and win the Uttar Pradesh elections or not?
Aisha, actually, I don't think either events are that critical. Okay. Our view is that we are coming to the end of the rate cycle. So there's probably one more rate cut left. Maybe it's next week, maybe it's the next RBI meeting. But there's not much scope left for rate cuts. I think inflation has more or less bottomed. Global growth is accelerating. The Fed is likely to hike rates. In that type of a backdrop, it is hard to believe that we can cut rates much more from here. So there's not much left. It also actually signals that India's growth is stabilizing and improving. So that's actually a positive. It's not a negative for stocks. As far as elections are concerned, my view is state elections don't assume so much importance unless they signal a big shift in trend. So what we need to know from the state election results is that does it signify a big shift in the country's mood towards which national party will run the nation. Firstly, this election is, these elections are 2 years, in front of the general election, so it's still far away. So at best, they have the capacity to produce some volatility, but I don't think they will disturb the underlying trend. And the underlying trend has more to do with global factors than local factors. So if you look at the explanation of India's returns over the past 3 months, 80% of the returns are explained by what EM is doing. People have probably not realized that since President Trump took office, emerging markets have beaten developed markets. And that wasn't the narrative when President Trump took office, because everybody was of the view that the dollar is going to rise and EM is going to be in pain. India has actually underperformed EM. Even in the month of January, we have had a spectacular rally in India, but India is underperforming. So imagine what emerging market countries are doing right now. And this is happening because I think global growth is accelerating. Morgan Stanley wrote a note last week highlighting the prospects of a potential upside surprise to our forecast in terms of global growth. And that lent support to India's economic environment because it was the missing ingredient of the last 2 years, a weak global scenario. So that seems to be turning at the margin.
I think I was just about to say that even after the rally, we are still probably underperforming the MSCI EM. But Ridham, good morning. The other bit is what this budget does to two things. One is whether it changes the EPS print for FY18, which arguably I don't think it does. But what does it do also to investor sentiment in a big way, right? No time bombs in the budget or the fine print. And in fact, a couple of very bold steps taken, including abolishing FIPB at some point of time in FY18 as well. Do you think EM outflows or India outflows have kind of bottomed out and we may actually see a fairly decent reverse ticket in terms of inflows coming in the current calendar?
Yeah, so I agree with you, Neeraj. I mean, I think what they are doing with FIPP is similar to what the government did with the Planning Commission. These are long-held institutions in India which served a certain purpose, but they have probably outlived their purpose. And the time has come to bid them goodbye. So it's a refreshing change. I think it also ties in with the fact that India has been the largest recipient of FDI in the world over the last 2 years. Again, gone less noticed. But a culmination of India's growth story as well as the work that the government has done. With regards to EM flows, yeah, there has been a turnaround in the last few days. Certainly people are noticing performance in EM and flows are following. Flows are generally a lagging indicator. Performance comes first and then flows follow. So if this performance sustains, and it's a big if, I don't know if it sustains, but if it sustains, then the flows will follow. For India, I think we have less to worry on that front because I'm of the belief that we are seeing structural shifts in the domestic household balance sheet, and equities is becoming quite popular as an asset class. We've already seen over the last 2 years on a cumulative basis, domestic flows have outstripped FII flows, and that hadn't happened for the previous 2 decades. So these are big shifts that are happening in India. I think that the domestic flows will sustain over the coming years, and therefore the relevance of FII flows will actually reduce. Nevertheless, there could be a cyclical shift which we may be dealing with, and that may lead to a pretty strong performance of the market if it happens. And then eventually, of course, the market will get overheated. But we're still away from that situation.
Ridham, broadly 45 to 50% of the earnings for Nifty is global in nature. And we know that there is a big reboot which has happened. IT from late teens will grow in single digit. Pharma from early 20s will now grow in teens. So whereas the inward looking sectors may pick up, energy and metals may normalize, the drag from IT and pharma will nullify all the recovery.
So I think materials will go from loss making to profit making, and it will take care of all the slowdown that has happened in IT. By the way, the IT slowdown is not today's story. It's been happening for a while now. So it's not a refresh or a reboot in terms of IT. What's happening in IT is, I think, a view that there is a structural depression in earnings that will happen, which is going to last for 5-7 years. And that's why the share prices or valuations are where they are. And that may be quite right, though I think that the sentiment has turned far too negative for IT, and therefore, if you're a contrarian investor, I think you want to buy this fear that is prevailing in IT. Pharma is more idiosyncratic. I think some companies will manage to grow because they will make use of the opportunities that are available. Others may not. But overall, it's the materials sector that will drive the performance of the Nifty. I would actually add one more thing here, is that while we classify these sectors as global, there's a fair bit of global earnings sitting in the so-called domestic manufacturing businesses like automobiles, like auto parts, like the manufacturing companies. Even consumer staple companies have got a fair bit of global earnings sitting in their overall earnings, and those earnings have been negative over the past 2 years, and if they turn positive, it will actually lift their overall earnings. So when you cite the 45% share, which is a number that I can verify, it does not just have IT and pharma and materials in it. It has also the earnings that large number of domestic companies have outside India. And those earnings, I think, are looking up. In fact, I won't be surprised if these exporting companies actually report much better than expected earnings over the next few quarters and surprise the street.
Since you do believe that there's still some time to go before the market gets overheated, what could emerge as that dark horse where you think valuation is still pretty ripe and has, massive headrooms from the current levels? We've been chatting with a slew of experts since morning, and all of them are betting big on PSU banks and some of the energy names like Reliance. What's top on your list?
Yeah, I think you could add the non-banking finance companies there, which have not recovered from the lows they hit in the month of December. I think they could probably share part of this rally. I think consumer stocks will also do well, but especially discretionary consumer, because consumption demand is very strong. So there could be a widespread rally if the market goes higher, and it will come from various places. So I think NBFCs and consumers may also stand out in that.
Ridham, you may want to stay with us because we are about to break a story on a Nifty.
I'll add one more thing. Yeah. Let me.
Please go ahead.
Yeah, and one more thing that I would like to add is that there is a shift in styles that has happened, which is the market is moving away from quality to value. And therefore, deep value stocks may actually do quite well in this environment. So people are looking for value, and a lot of sectors and stocks fit that description. So you may want to keep a look at value stocks.
So I think Ridham has a meeting, I'm told, and Ridham, so in order to make you get your meeting in time as well, just a quick comment here on this nature. You may not have a comment on specifically IndusInd Bank, appreciate if you do, but the nature of what banks are doing, private banks buying out MFIs, IndusInd Bank likely to buy a very large or merge a very large MFI with itself.
See, I think, Neeraj, we discussed this in early Jan when I was at your studio. We are at the beginning of a big M&A cycle in India. There are 4 reasons for that. M&A has been very depressed for the past few years. The last time we had high M&A activity was in 2007. Valuations are actually quite attractive relative to the growth prospects. Growth is turning, so confidence is coming back, and free cash flow in the corporate sector has turned positive for only the second time in 2 decades. So people have the money to do deals. So I think you are going to see more and more deals come through. I'll make that broad comment. I don't want to get into the specific one, but this is just the beginning of what's going to be a fairly big M&A cycle in India.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.